Welcome to Cashflow Positive, your go-to channel for all things finance. Our mission is to provide you with valuable insights into the financial world, taking complex concepts and breaking them down into understandable, digestible nuggets of knowledge. Whether you're just beginning your journey into finance or you're a seasoned investor looking for fresh perspectives, Cashflow Positive is here to help you navigate the often confusing tides of financial information. We believe that, with the right tools and understanding, everyone can take control of their financial future. So let's dive in together and demystify finance one video at a time. Today we're tackling an essential tool for any investor, the stock chart. We're going to break down the complex world of stock charts into easy to understand steps, giving you the confidence to read and interpret them like a pro. So let's start our journey into the world of stock charts. First off, what exactly are stock charts? Well, picture this. You're on a journey, exploring the financial wilderness, and stock charts are your map. They guide you through the vast landscape of the stock market with their lines, bars, and indicators, helping you understand where a particular stock has been and where it might be heading. You see, stock charts are visual representations of a stock's performance over a specific period of time. Think of them as snapshots of a company's financial heartbeat, giving you a glimpse into the past, present, and potential future of a stock's price. But stock charts are not just about price. They also display volume, which refers to the number of shares traded during a certain time frame. Volume can provide insights into the intensity behind price movements. For instance, a high volume often signifies strong investor interest and can indicate the beginning of a new trend. In addition to price and volume, stock charts also convey the time period. This could range from a single trading day to multiple years. The choice of the time period depends on the type of investor you are. If you're a day trader, you might look at minute-to-minute charts, while long-term investors might prefer weekly or monthly charts. Now you might wonder, why are these charts so important? Well, these graphical depictions aid in understanding market trends and patterns. They help investors make informed decisions based on historical data, rather than just gut feelings or hearsay. It's like having a crystal ball that, while it doesn't predict the future with absolute certainty, can give you a sense of what to expect based on past trends. So to put it simply, stock charts are a tool. They are a means to an end, the end being successful investing. They provide you with the data you need to make informed decisions about when to buy, when to sell, and when to hold your position in a stock. Understanding stock charts is essential for any investor looking to make informed decisions. Because in the realm of investing, knowledge truly is power, and stock charts are one powerful tool in your investment arsenal. There are several types of stock charts, each with its unique presentation. Diving into the world of stock charts, you'll come across three main types: line charts, bar charts, and candlestick charts. Each of these charts has its own way of illustrating price movements, and each comes with its own set of strengths. First up, we have line charts. These charts are the simplest of the lot, presenting a clear and uncomplicated view of price movements over time. A line is drawn from one closing price to the next, creating a continuous line that gives a general idea of a stock's price trajectory. This type of chart is great for getting a quick, broad stroke overview of a stock's performance. Next in line are bar charts. A step up in complexity from line charts, bar charts offer more detailed information. Each bar represents a specific time frame, a day, a week, a month, and so on, and shows the opening and closing prices, as well as the highs and lows for that period. The top of the bar shows the highest price, the bottom indicates the lowest price, and small horizontal lines on the sides represent the opening and closing prices. Bar charts are excellent for traders who want a more detailed picture of price movements. Last but not least, we have candlestick charts. Originating from Japan over 300 years ago, these charts are a favorite among many traders. Like bar charts, candlestick charts show the opening, closing, high and low prices for a specific period. But they also use color to indicate whether prices increased or decreased during that period. The main body, or the candle, represents the range between opening and closing prices, while the wick shows the entire range of trading prices for the period. Candlestick charts provide a visually rich depiction of price movements, making them a popular choice for technical analysis. Choosing the right chart type can be instrumental in your stock analysis. Each chart type offers a different perspective and level of detail, so understanding the strengths of each can help you make informed trading decisions. Now that we know what stock charts are and their types, how do we read them? Well, it's like reading a book, but instead of words, we have lines, bars, and numbers. The first thing to note is the X and Y axis. The X-axis represents time, whether it's hours, days, weeks, or even years. The Y-axis, on the other hand, represents the price of the stock. Now, onto the bars or lines you see on the chart. Each bar or line represents the price movement of the stock for a specific time period. The top of a bar shows the highest price the stock reached during that period, while the bottom shows the lowest. If it's a line chart, it's a bit simpler. The line simply traces the closing prices for each period. Next, let's talk about volume. This is typically shown as vertical bars at the bottom of the chart, and it represents the number of shares traded during a specific period. A high volume bar means many shares were traded, which could indicate strong investor interest or a significant event related to the company. But how do we interpret all this? Well, the price and volume data work together to tell a story. For example, if a stock's price is increasing and the volume is high, this could indicate a strong upward trend. Conversely, if the price is falling and the volume is high, this might suggest a strong downward trend. Another important element to look out for is the moving average, which smooths out price fluctuations to help identify the stock's trend direction over time. It's like a line that dances with the stock's price but doesn't get too caught up in the daily ups and downs. Finally, don't forget about the dates and prices on the axes. They provide the context for everything else that's happening on the chart. By understanding these components, you can begin to interpret a stock's performance. So, start practicing with different charts and soon you'll be reading them like a pro. Interpreting stock chart patterns is a fundamental skill for investors. It's like reading a story where each pattern reveals a piece of the puzzle. Let's delve into some common patterns that can provide clues about a stock's future performance. First up are trend lines. These are lines drawn over pivot highs or under pivot lows to show the prevailing direction of price. Trend lines can be upward, downward, or sideways, indicating bullish, bearish, or neutral market sentiment respectively. An upward trend line, which connects at least two low points, indicates that investors are buying on dips, showing a positive sentiment. Conversely, a downward trend line, connecting at least two high points, suggests that investors are selling on rallies, indicating a negative sentiment. Next, we have support and resistance levels. Think of these as invisible floors and ceilings that prices tend to bounce off. Support is a price level where buying interest is strong enough to overcome selling pressure, preventing prices from falling further. On the other hand, resistance is a price level where selling pressure overcomes buying interest, hindering prices from rising further. These levels are key indicators of price movement, as a break above resistance could signal a bullish trend, while a break below support might suggest a bearish trend. Another common pattern to look for is the head and shoulders pattern. This pattern consists of three peaks, with the middle peak, the head, being the highest, and the two other peaks, the shoulders, being lower. This pattern is a bearish reversal signal, suggesting that the stock may be set to drop. Lastly, we have the double top and double bottom patterns. A double top pattern resembling an M suggests a bearish reversal, while a double bottom resembling a W signals a bullish reversal. Recognizing these patterns can provide valuable insights into potential investment opportunities. But remember, while chart patterns can be useful, they aren't foolproof. Always consider other factors like company fundamentals and market conditions in your analysis. Stay sharp, stay informed, and you'll be well on your way to mastering the art of stock chart interpretation. Stock charts, while complex, can be understood with a bit of practice. We've unpacked the mystery of these charts today, exploring their nature, types, and how to read them. We've also delved into the art of interpreting stock chart patterns, a crucial skill for any successful investor. Remember, understanding these charts is not just about numbers or lines on a graph. It's about comprehending the story of a company's financial health and predicting its future. It's about making informed decisions that can potentially lead to significant financial gains. So don't shy away from these charts. Embrace them, learn from them, and use them as your compass in the vast sea of investing. With practice and patience, you'll soon be able to navigate the stock market with confidence. Remember to subscribe to Cashflow Positive for more interesting facts on finance, and hit that thumbs up button if you found this content useful. It really helps the channel. Until next time, keep your cash flow positive.